The first half of 2025 was a period of recalibration for Nigerian economy, which shows signs of recovery and resilience after the significant shock of the previous year. Welcome to Business Point, where we extract the Nigerian economy and the government's policies. While structural challenges persist, the economy saw an increase in activities and a gradual reduction in inflation. Key domestic developments include the rebasing of the gross domestic product and consumer price index, which provided a more accurate picture of the Nigerian economy as Nigeria's GDP grew by 3.13% in the first quarter of 2025, in a less severe inflationary environment for June 2025 at 22.22%, while the Central Bank of Nigeria maintained an hawkish stand and held its benchmark interest rate steady at 27.5%. Also worthy of note is the passing of 4 major tax reform bills aimed at improving fiscal sustainability. Amid all this, Nigeria remained vulnerable to external factors like volatility, oil price, and global trade disputes. Globally, the economy was marked by a mix of resilience and vulnerability shaped by the re-emergence of U.S. trade tariff. The U.S. economy contracted by 0.5% in the first quarter of 2025. Its first decline since first quarter 2022, primarily due to a sharp increase in imports and businesses and household front-loaded purchase ahead of the anticipated tariff. In contrast, the UK economy expanded by 0.7% in the first quarter, its strongest quarterly growth since first quarter of 2024, underpinned by a surge in home buying and resilient manufacturing. Similarly, the euro area recorded notably growth of 0.6% in the first quarter, with a strong performance from the Irish economic multinational sector. Meanwhile, China's GDP grew by a stronger than expected by 5.4% in the first quarter, driven by a consumer goods trade in program and a pre-tariff rush by the exporter, though the sustainability of this growth remains in question. Overall, the World Bank projects a slowdown in global economic growth to 2.3% in 2025, the weakest pace since 2008 outside of recession. Looking ahead of the second half of 2025, the report anticipates that Nigeria recalibration will continue. The fixed income market is expected to see a gradual correction in yields as there is growing speculation that the CBN might cut interest rates to support economic growth. At the same time, the equity market is projected to continue its positive trend, supported by strong company earnings and improving investors' confidence. In terms of journey towards reaching a $1 trillion economy, the report recommends a coordinated and transformative policy action that drives partnership between private and public sector. While the path to full economic normalization is ongoing, the report concludes with a sense of caution optimism, suggesting that the second half of the year will be an opportunity for both policymakers and investors to build on stabilizing trends and navigate the evolving landscape with a careful foresight. The federal government earned 21.22 trillion naira as revenue from the activities of 5 revenue-generating agencies in the first 6 months of 2025. This shows that the government intensified its drive to boost the nation's income, rolling out aggressive collection strategies, tightening enforcement measures, and expanding its operational reach to capture more taxable and non-taxable revenue stream. However, the 21.22 trillion naira earning in just 6 months did not stop the government from cutting foreign lenders for loan and grants. The half-year windfall, driven by stronger tax collection, oil royalties and custom duties has not slowed down the nation's aggressive borrowing push, a move economists warns could deepen Nigeria's debt burden and strain its finances in the long term. The amount generated was distributed among the 3 tiers of government, including the federal, state, and local government, in line with the country's revenue allocation formulation to fund critical projects and service nationwide. An analysis of the revenue performance of the 5 major government agencies between January and June 2025 shows a strong inflow of funds, with tax receipts, custom duties, and oil royalties surpassing projection. The data contained in financial reports submitted to the Federal Accounts Allocation Committee underscores the government's improved revenue mobilization drive under the 2025 budget. Recall that in 2024, after the Senate approval of the government approved a 54.2 trillion naira budget tagged budget of restoration, securing peace, rebuilding prosperity. The spending plan was increased from the earlier 49.7 trillion naira proposal on the back of higher than expected collection from the key revenue generating agencies. The 2025 fiscal framework targeted 36.35 trillion naira in total revenue, anchored on an expanded tax base, enhanced custom operations, higher returns from government-owned enterprises, and robust oil receipts based on a crude benchmark of $75 barrel per day, a daily production target of 2.06 million barrel per day, and an exchange rate of 1,500 naira to a dollar. 6 months into the implementation of the 2025 budget, fresh figures have shown that 5 key revenue generating agencies have collectively earned over 21.22 trillion naira, generating a substantial amount of their revenue target and putting the federal government more than halfway towards meeting its full-year revenue target. Data obtained reveals that the Federal Inland Revenue Service led the pack, collecting a record of 13.76 trillion naira between January and June 2025. The Nigerian Upstream Petroleum Regulatory Commission followed with 5.21 trillion naira in oil royalty and related earning, while the Nigerian Customs Service contributed 2.02 trillion naira through the collection of import duties and tariffs. The Ministry of Mine and Steel Development generated 32.39 billion naira, while the Nigerian National Petroleum Company Limited reported earning of 197.8 billion naira from its commercial operation. But in its monthly report, the NNPC disclosed that it had remitted 6.96 trillion naira in statutory payments between January and June 2025. This doesn't tally with the figures submitted by the Federal Accounts Allocation Committee. The combined amount represents about 42.23% of the 50.2 trillion naira revenue target set for FIRS, which is 25.2 trillion naira, NUPRC 15 trillion naira, and Nigerian Customs Service 10 trillion naira. It is also 58% of the government's 36.35 trillion naira projection for 2025, indicating that the administration is on the track to surpass its fiscal target if the momentum is sustained. However, despite the strong performance, the government has continued to cut foreign lenders for loans and grants to plug budget deficit and fund large-scale infrastructure projects. The government has maintained an aggressive borrowing posture, turning to multilateral lenders, bilateral partners, and foreign financial institutions to finance its fiscal deficit and fund critical infrastructure. Data from the Debt Management Office shows that Nigerian public debt rose to 149.39 trillion naira as of March 31st, 2025, marking a year-on-year increase of 27.72 trillion naira, that is 22.8% compared to 121.67 trillion naira recorded in the corresponding period of 2024. Total debt of the World Bank rose to 18.23 billion naira as of March 31st, 2025. This marks a $420 million increase in just 3 months since December 2024, when the Nigerian total exposure to World Bank stood at $17.81 billion. The Nigerian Customs Service has issued a 2 weeks grace to importers and agents of 905 cargoes currently domiciled at various ports in Lagos to clear them or risk forfeiture to the federal government. The service in a notice explained that over time, cargoes are domiciled at Apapa, Tinkan Island and the Port and Terminal Multipurpose Limited Command of the Nigerian Customs Service. Over time, cargoes are consignments that have stayed beyond the estimated time at the port. The service warns that at the expiration of the 2 weeks grace period, it will initiate the process for disposing of the overtime cargoes. The NCS says it will commence the process of disposal of all uncleared overtime goods immediately after the expiration of the grace period. According to the notice, out of 905 overtime cargoes, 40 feet containers took the largest chunk with 438 pieces, while 20 feet containers accounted for 120 pieces. The notice also shows that about 60 used vehicles of different models and years made the list, while groupage containers were 60 pieces and scrap metals were 15 pieces. This is coming barely a year and 6 months after the Comptroller General of Customs, Adewale Adeni, inaugurated a committee to dispose of overtime cargoes to fast-track the movement of imported goods and those for export. Recall that in November 9, 2023, the spokesman of the NCS, Abdullahi Maiwada, stated in a statement that the CGC has inaugurated the Committee on Disposal of Overtime Cargo at the organization headquarters in Abuja. These developments arise in response to the new Customs Act provision, which empowers the NCS to dispose of containers that have exceeded their allotted time within the port. Adeni emphasized that alleviating port congestion stands as a paramount objective for the Nigerian Customs Service, as well as President Bola Ahmed Tinubu's offering the promise of heightening efficiency and enhanced trade facilitation. Meanwhile, the image maker of the service, Maiwada, noted that the worth of the containers and the vehicles varies, stressing that the importers are encouraged to come forward and clear their goods. The Nigerian Midstream and Downstream Petroleum Regulatory Authority has identified poor electricity supply as a major challenge stalling Nigerian electric mobility transition. The agency also pointed to high cost of electric vehicles and limited infrastructure as key barriers. Speaking at a webinar organized by the Major Energies Marketers Association of Nigeria on the theme Accelerating Electric Mobility Adoption in Nigeria by Unlocking Downstream Potential, the Director of Operation Distribution System Storage and Retailing Infrastructure at NMDPRA, Dr. Mukaila Hussaini, situated Nigerian electric vehicle journey within a global context, referencing the International Energy Agency forecast of 145 million electric vehicles worldwide by 2030. It says the barriers slowing the EV adoption in Nigeria include high vehicle cost, limited charging infrastructure, unreliable grid electricity, and low public awareness. Hosseini stressed that without urgent intervention, the country may struggle to keep pace with the global energy. According to him, EV are critical to diversifying Nigeria's energy mix, reducing long-term transport costs, and cutting emissions. However, he warns that significant barriers persist. He advocated for leveraging Nigeria's expansive downstream network of fuel retail stations as ready-made sites for electric vehicle charging, supported by mini-grid to ensure reliability, tying EV to Nigeria's decades of gas strategies. He underscores how compressed natural gas and liquefied petroleum gas can provide transitional solutions while EV adoption scales. All right, let's take a quick short break. We'll be right back. Don't go away. Stay with us. Welcome back. If you're just joining us, it's Business Point on Global Television, where we extract the Nigerian economy and the government policies. The Revenue Mobilization, Allocation and Fiscal Commission has commenced a fresh review of the formula for allocation of the national revenue among the three tiers of government. Disclosing this in Abuja, the chairman of the commission, Dr. Mohammed Shehu, stated that the commission has resolved to initiate the process of reviewing revenue allocation formulation to reflect emerging socio-economic realities. The current formula stands at 52.69%, states stood at 26.72%, and 20.60% to the federal, state, and local government respectively. The commission had prepared a revenue allocation formulation in 2022, but it was jettisoned by the 9th Assembly due to constitutional amendment, which it undertook, which devolved certain responsibilities such as generation, transmission and distribution of electricity, railways and correctional centers from the exclusive to the concurrent legislative list, which have placed financial and administrative burden on subnational governments. Dr. Yusuf further stated that the situation has made it essential to re-evaluate the structure of fiscal federalism in order to foster economic growth in individual states, enabling them to become independent from the central government and ensuring equity, responsive and sustainability. The aim of the review is to produce a fair, just and equitable revenue sharing formula that reflects the current responsibilities, need and capacity of the three tiers of government and federal, state, and local government in line with their constitutional role. Lafarge Africa PLC has recorded sales revenue growth of 70% to 268.63 billion naira for the second quarter of 2025 financial year against 157.80 billion naira that was recorded in the corresponding period of 2024 second quarter. A breakdown of the unaudited results released to the Nigerian Exchange Limited last week reveals that operating profit also grew to 120.61 billion naira, representing 153% from 47.70 billion naira in the corresponding period of 2024. This rise in operating profit, according to the company, was largely due to top-line growth and operational efficiency. According to the provisional result released by the NGX, profit after tax for the second quarter rose by 248% to 84.03 billion naira in the corresponding period in 2025. This rise could be attributed to strong operational performance, relative stability of naira with no significant FX losses. Chief Executive Officer Lafayette Africa Laolu Alade Akinyemi in a statement explained that the exceptional performance recorded by the company in the second quarter was driven by innovative products offering strategic operation and distribution efficiency. He stated that following the impressive in the first quarter results and second quarter performance showcased the strength of the team, market positioning and operational efficiency, cost management and dedication to value creation. The company has achieved excellent financial results in the second quarter with a net sales growth of 70%, operating profit up to 153% and profit after tax growth of 248%. This strong performance closes first half of the year with a sales and operating profit growth of 75% and 144% respectively. This performance is driven by the innovative product offering and strategic operational initiative. Commenting on the projection for the second half of the year, it stressed optimism of a positive outlook, anticipating that the market will maintain a growth rate consistent with the trend from the first half of the year. All right, this is where we draw the curtain on Business Point today. Join me again tomorrow on Global Television channel 365 and Star Time channel 276. To stay connected, kindly follow us on all our social media platforms at Global TV NG. Till I come your way again, I am Kike Lomo Okeri. I celebrate you all.